Hello, everyone. My name is Jack Greenberg. I'll be your host for today's episode of the Small Cap Insights podcast powered by Darrow Associates. We are a leading full service investor relations firm that's focused primarily on micro and small cap equities. Our guest for today will be Bob Daigle, the Chief Executive Officer and Chairman of the Board of Amtech Systems, traded on the NASDAQ under the ticker ASYS. Bob, thanks for joining us today.
Good morning, Jack, and looking forward to our discussion this morning.
Likewise. So for listeners who might be new to the company, can you give an overview of the business, some of the key markets that you serve?
Sure, happy to do that. So for Amtech's revenue on an annualized basis in the range of 75 to 80 million dollars, and we have two reporting segments. Our largest segment, which we refer to as Thermal Process Solutions, accounts for over 70% of our revenue. This business is focused on advanced semiconductor packaging. We also have parts and services parts of that business. And our primary application area is today is really advanced packaging for and electronic assembly for AI related infrastructure that includes GPUs and the TPUs. We also have a second segment, which we refer to as Semiconductor Fab Solutions, and that's focused on consumables, parts, and services for chemical mechanical planarization, often referred to as shortly as CMP. And our products are used for conventional and advanced substrates.
Got it. That's some helpful background. So you stepped into the CEO role about 2 years ago and served on the board prior to that. Uh, what were the conditions of the business kind of when you took over as CEO and what were your immediate priorities?
Yeah, so when I stepped into the role, it became apparent we had some financial issues. We had over $11 million of debt, and we were burning millions of dollars of cash every quarter. So it was really there was a lot of urgency around dealing with the financial situation the company was in. And there were a few pieces to that. One of which was really looking at some of the cash burn was associated with some pretty significant working capital needed for some of the legacy equipment business that had a relatively low margin profile but required a lot of working capital. So it was consuming a lot of cash with, frankly, marginal returns as well. We also had other parts of our business where, as we dug in, we realized, these were products that, we sold in some cases less than $1 million a year of, but required a very substantial amount of fixed overhead, had low margins. So we did some work really rationalizing those product lines. The priority one was really survival. It was really needing to get each of the business segments to EBITDA positive as quickly as possible, and also putting better practices in place so we managed working capital more effectively.
Yeah, that's really helpful. So you mentioned a couple kind of the optimization initiatives you took, but can you expand on those a little bit and
Or
how did they
yes,
translate into?
yeah, happy to do that, Jack. So again, product line, I'd say the first two areas that we focused on in the early days were some of the product line rationalization I mentioned earlier, some products that frankly probably hadn't made money in 5+ years and were consuming a lot of cash. Then it also became apparent that pricing was an issue. In many cases, we had some of our equipment that pricing hadn't really been prices hadn't been raised in 5 years, and in spite of inflationary pressures. So it had resulted in some parts of the portfolio that had very low margins as priced. So that really was that first way of dealing with pricing, dealing with some product line rationalization. However, I'd say the most significant contributor to the financial turnaround was really the recognition that we needed to change the business model for some significant parts of our equipment business. Uh, a lot of these were highly cyclical areas, highly cyclical application areas where, boom or bust. And frankly, what was happening is in the boom days, we were struggling to get enough equipment out the door. And in the bust days, we were sitting on a tremendous amount of fixed overhead. So we made the decision to migrate to a semi-fabless model where we partnered with contract manufacturing organizations, which had the ability to scale more effectively when demand was strong, but also put us in a position where in lower demand environment, we basically weren't burning a lot of cash. So I'd say that's probably the most significant change. We eliminated 3 manufacturing operations. We now operate in 4 plants. We were at 7. The combined savings were just over $13 million with the structural changes we made. And we did a lot, frankly, in terms of changing our EBITDA break even. It was, north of 110 million of annual revenue. And today I'd say we're sitting at about 75 million, let's say, for break even revenue for EBITDA. So all in, that basically put us in a much better place from a cash flow perspective. By the end of 2024, we were able to pay off all the debt. And as we recently reported, by the end of 2025, we had just under $18 million of cash on the balance sheet.
Well, congratulations. That's obviously no small feat. But now that some of that heavy lifting is behind you, how would you describe the next phase, kind of a revitalization of the business?
Yeah, and then as you mentioned, the 3 themes we've talked about with the investment community were survive, optimize, revitalize, right? So we spent the first 6 months of that 2-year period really around mitigating cash burn for survival. We spent really the balance of that 2-year period really optimizing, going to that semi-fabless model, and basically getting our cost structure in a better place. And we've seen the benefits of that in the fourth quarter of 2025, our most recent quarter. Our adjusted EBITDA margins were about 13% with revenue just below $20 million. So we've got in a much better place from cost structure and from an operating leverage standpoint. We're in a good place. So now it's all about, revitalize. It's about driving growth. And my expectation is we drive double-digit organic growth in both segments of our business. And to deliver on that strategy, we're really, really leveraging our strengths. We have a great position in terms of our equipment for packaging and advanced assembly operations that we're fortunate to be in a great space right now, AI-driven applications. But again, we're going to invest, and we are investing in ensuring that we fully capitalize on those opportunities, not just riding the wave here, but making the best with in terms of having the current generation as well as next generation equipment for those applications.
Yeah, and
So yeah, please, Doug.
I'd like to talk a little bit about your semiconductor packaging, particularly for AI. Can you talk a little bit about the demand that's driving that market and, how you're positioned to capitalize on that demand?
Yeah, we're pretty in terms of our market position. I'd say the vast majority of AI GPUs, TPUs are manufactured using our equipment. So we're in a great market position from that perspective. In terms of the investment cycle, I mean, every time you pick up the paper, listen to the news, there's tremendous amounts of investments in AI infrastructure that are benefiting us. And that's translating into our customers it's a combination of adding equipment to existing facilities, but we're also seeing a lot of new facilities being put in place to support the tsunami of AI infrastructure demand. So again, great position. We're benefiting from these data center investments that are being made globally.
Yeah, that's really nice. So, you mentioned investing in kind of the next generation of packaging equipment. What do those capabilities look like, and how do they expand your total addressable market?
Yeah, if if you look at the technology roadmaps in terms of where the industry is going, higher density packaging is and the capabilities needed to do that in a continuous high volume process, are areas where we see the opportunity to create higher value equipment, solve customer problems in terms of being able to produce large volumes of these advanced packages uh, continuously. And we see that as an opportunity to increase our participation in two ways. One, we participate in a couple of process, sequences right now for producing these advanced packages. We see the opportunity to potentially participate in more of the operations.
Mhm.
But the other dimension to this is really the more demanding the application, the higher value we can create with our equipment.
And so turning to your semiconductor fab solutions segment, what opportunities do you see in the CMP consumables and services there?
Yeah, so we participate in in a variety of chemicals and in some cases templates, materials, and also aftermarket parts for in the CMP area. I'd say the biggest opportunity we envision is really around our chemicals business. It's very nice margins. We have, I think, a unique capability in our foundry where we're working with customers on with emerging substrates. We're also working with customers as they come in and because of some dislocations, maybe their existing supplier isn't supporting them well with current products. So our theme really is overserving the underserved. We see a great opportunity really to play in niche markets. Maybe some of these niches become mainstream as the emerging substrates, grow in scale. But we see an opportunity, frankly, to build a nice business around low, medium volume chemicals. And these can be cleaners, they can be lubricants, they can be slurries that are used in semiconductor wafer fabrication where we think we can provide value. We've built a great team to do this. We've got a lot of top talent in the industry that's available to serve our customers and help them be more successful.
Yeah, I really like that phrase, overserving the underserved. So you spoke a little bit about strong operating leverage as you come out of the optimization phase. If you look forward kind of 12 to 24 months, what should investors, excuse me, expect to see as those revitalization efforts begin to take hold?
Yeah, so again, I guess my focus is really, controlling what we can control. And I expect, I'm driving our initiatives really around the thought that we should be a double-digit organic growth company.
Mhm.
Having said that, in parts of the business we talked about, there's a lot of great tailwinds in the AI related chip packaging part of the business. On the CMP related parts of the business, a lot of that's more mature node, and that market, frankly, has been depressed for a couple of years now. So, but frankly, I see us as control we can control, deliver double-digit growth organically. But obviously, if the tide comes back in and the more mature node CMP market will also benefit from that.
Yeah. And so last question here, kind of to wrap it up. Is there anything you'd like investors or stakeholders to keep top of mind as Amtech enters the next phase of its transformation?
Yeah, so so again, we covered a lot of ground, but I'd say the one area we didn't really um, talk too much about is really with the new operating model, which is, referred to as semi-fabless, where we've got a lot of very limited fixed costs. We've generated the operating leverage, but the other element of that is really around free cash flow. Because of the very limited CapEx requirements to scale, I expect we're going to be able to grow the company with minimal capital investments. So our free cash flow it should be very similar, frankly, to our operating EBITDA or operating cash flow. So I think we're well positioned, in terms of creating strong returns on invested capital and strong free cash flow going forward.
Well, that's great, Bob. Thank you again for taking the time out to be on the Small Cap Insights podcast. I'm really looking forward to see what the future holds for Amtech. For listeners that are interested in learning a little bit more about the company, their investor materials are on the investor segment of their website, amtechsystems.com. And if you enjoyed today's conversation, please follow Darrow Associates on all social medias. Thanks again, Bob.
Thank you, Jack. Take care.
You too.